fuboTV is down about 80% from its high just earlier this year, and investors are wondering, is it finally game time for fuboTV, FUBO stock, FUBO stock? Hopefully not FUBAR. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in fuboTV, FUBO. And so what is FUBO? FUBO aims to be the leading sports-first live TV streaming platform. And so it's a traditional subscription type business. You have your various different tiers and what you pay for access to various different channels, events, and cloud storage and additional features. And they've grown quite significantly over time, have over 1 million paid subscribers as the fourth quarter 2021, hundreds of millions of hours streamed. And you could see that they're growing at a hyper rate, over 100% revenue growth in the fourth quarter. For all of 2021, they were growing closer to 140% growth, which is really something. And so what are you seeing that's driving this? There's a number of variables, one of which is just getting more subscribers, more paid ads. You could see sequential subs increasing over time. You can see advertising revenue has also grown at a hyper clip. You've also seen that they've done mergers and acquisitions, buying their way into expansion. And so this isn't just a, let's say, sports platform for the United States. They're rapidly looking at how can we expand this around the world? Okay, how do we get Canada? How do we get Spain? How do we get France? And so in this case, they were buying a platform called Molotov that gave them access to France's #1 live TV streaming company. And then next is FUBO Sportsbook. This is another venue for future growth. It's currently only available in 2 states now, Iowa and Arizona, but should be rapidly expanding in the years ahead. They already have conversations with numerous, states. And, the appeal here is that, hey, wouldn't it be awesome to be able to watch a game in real time and then actively participate in the sports betting if that's your thing? So that way you could sort of interact on a real-time basis, sort of saying, oh my goodness, the spread on this is really outrageous. Did you see that home run? That sort of stuff. So I see the appeal there. It's not for me personally, but I could understand why this could be a huge market over time for them. At this point, it's really not driving their business, but it does have a lot of potential, clearly, potentially very high margin business. So there are really management calls out 3 factors that could drive huge, growth, 3 megatrends driving FUBO's business in the years ahead, including the secular decline or the secular shift from legacy linear pay TV to streaming services, streaming platforms like fuboTV, the cord cutting. The next aspect is this radical shift from ad spend where folks say, wait a second, linear TV isn't getting the return on investment from an advertiser's perspective. They want to get a better return on investment for an ad shown. And they're saying, hey, we can customize these ads better for the very specific audiences we get with streaming services. And so here it is, more ad spend going to connected devices, connected platforms like FUBO. And so that is a hyper growth channel for them. And then also this online wagering that I just talked about, the integration of sports betting with real-time TV viewership. This was also an example of them doing an acquisition to get into the space, buy the technology. What's my take as I look at fuboTV? So there's a couple of different components one needs to consider. And also just taking a step back, usually I do a plug talking about Unrivaled Investing, or if you're interested in, finding a community of investors, looking for exceptional companies, Unrivaled Investments, consider checking out unrivaledinvesting.com. Click Join the Journey. Also have an exclusive server where I'm interacting on a regular basis. And so looking at fuboTV, the concerns, the pros and cons of what I'm seeing here is first, there's a huge cash burn with the business. This is the cash flow statement. You can see their operating cash flow is negative $192 million. So a huge cash burn. When you factor in, the things that they're investing in, it's closer to $200 million plus, cash burn. That is really, really high, especially relative to their cash balance, which we'll talk about in a second. But just to understand, okay, is this reasonable cash burn? Is the model just, are they spending it all on sales and marketing, or is it something else? And the reality is, when you look at what they're spending, effectively what their expenses are as a percentage of revenue, the reality is they're nowhere near scale. They're nowhere near proving that they have a valid business model at this point because of the fact that they're spending more on content, broadcasting rights, and subscriber related expenses than revenue. That's before anything like sales and marketing, technology, G&A. And so the reality is they're effectively, for every dollar in terms of revenue from subscribers, they're actually spending more than that on the associated content. Now, I can understand, part of the appeal of saying, hey, and keep in mind, it's associated content, broadcasting rights, and effectively subscriber-related expenses. So I look at this and I'm sort of saying, maybe they're doing this to sort of do a land grab. Let's grab as many people as we possibly can over time. But the reality is 200 million cash burn is really high, and it's not a sustainable strategy, obviously. And so the question is, can they prove out their operating margins? And you do have certain, levers that need to get played over time, like, switching into the sports wagering business and growing that. If that's lucrative for them, that could change the business model. But, looking at where they are with their cash burn relative to their cash, they currently have less than 2 years of cash on their balance sheet, under 400 million in cash versus nearly a 200 million cash burn. So they need to rapidly change this business model in terms of getting to scale, proving the unit economics, proving that, hey, we can be profitable, or shareholders are just going to get incredible dilution, and your relative ownership of the pie is just going to shrink dramatically if you're a Fubo TV shareholder. I really don't like being in the position where I effectively have to rely on the kindness of strangers for future capital raising. And so that's the part that makes me nervous with a business model like this, where you're saying, wow, that's really a lot of cash burn. There's a good chance they might need to raise money. Will they be able to raise money on good terms? And that's the tough part that you don't know, because, imagine if for some reason capital markets just stop tomorrow, and you have trouble accessing the markets to raise money, either by issuing stock, issuing bonds, something, then Fubo TV could be in a really tricky position. They could be in a position where they, might be forced effectively to sell themselves to another player for pennies on the dollar. So I do not like that type of situation. If there's an angle here that you feel like I'm missing, I definitely want to hear it. Now, these are my concerns. I'd rather look for that self-financing business model. They've already proven that they can either operate at break even or be profitable, and they're growing. When you have that sort of setup, then it's like, oh man, this is great. You're not going to be facing this huge dilution, and they're self-financing rapid growth. Now, they do have really nice growth, and maybe there is huge upside potential, but I look at this and the risk is just too hard for me. And so then you start thinking about, well, wait a second, could there be just huge upside from here? Let's look at Netflix, for example, price to sales ratio of around 6 times. That's a big if, because Netflix has sort of started proving their profitability. At least they have accounting-based profitability. They may not be significantly free cash flow generating, but you'd say compare Netflix, let's say, to Fubo. Fubo's nowhere near in terms of proving their business model, but Fubo is at like 2 times sales. So if you were to say, like, hey, if in the future you were to look at Fubo and they were able to prove their operating business and say, yes, over time we can get to 10, 20, maybe even 30% margins, maybe that's layering in their sports book and things like that, then you could see hundreds of percent upside, because you could have this sort of thing like, hey, if this gets to self-financing and you're not worried about that cash burn, you could get in a situation where investors go, wow, this could actually be as lucrative as Netflix, has this huge growth runway. And you see Netflix trading, as I just showed, Netflix trading around, 6 times currently, but it has traded in a range of, let's say, 8 to 10 times in the last couple of years. And so even more in the past. So given that, Fubo is currently trading at 2 times, you could make the case, hey, if they can get to a Netflix type margin longer term, 20 to 30% profit type margin, then could it have a much higher multiple? And so that's the question investors would want to ask themselves. But keep in mind, Fubo and Netflix have very different business models, where Fubo is effectively this sort of cost taker, with regards to content. They don't get a sort of shape like, hey, this is how much we're going to spend on these one-off bets. Like Fubo TV isn't going to have a Squid Games where they spend a couple $1 million and it's just like, holy smokes, this became a worldwide sensation. The return on investment is incredible. Whereas, what they do for the most part, I would expect, is if they're going to have a big event, they're going to have to pay through the nose. They know it's a big event. They're going to, they're paying for it effectively. for the access. So that is the challenge. I think when you're looking at sports, a lot of the control, a lot of the, in terms of that leverage, that negotiation standpoint, I think a lot of the leverage goes with the sports owners, the sports team owners, in terms of leveraging what they can get for the content owners versus effectively the broadcasters, the platforms. And so I look at fuboTV, and it's a tough position that they're in given their cash burn, but who knows, clearly a lot of upside potential if they can start proving out their unit economics. I would be open to revisiting fuboTV if they could prove their unit economics, if they either turn down that cash burn significantly, or you start seeing even profitability. And that might be, it might be through several levers, like advertising, which is very high margin, or it's through sports wagering, which honestly they really need to prove out. But I'm looking at what they've done so far with their core business, and the reality is for every dollar coming in, it's like they're spending $1.05, $1.10 on content and subscriber related expenses. So it's a tough, view right now, but it's an interesting playbook. I'm very curious how it shapes up. It's too hard for me personally. I'd rather wait for the business that's already proven their unit economics. If you want to see other types of companies that I am pulling the trigger on, or companies that I do think are potential multi-baggers that maybe already proven themselves or are more on the speculative side, once again, check out unrivaledinvesting.com, click join the journey. And if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for tuning in. I also want to hear your take. If you have a strong opinion on fuboTV, if there's an angle you feel like I'm missing either on the upside or downside, I definitely want to hear it. So I appreciate the comments below. Thanks so much.